Welcome. In this video, if XCN coin breaks which level, hard rise comes, we will analyze it. Don't forget to subscribe and like, and please watch to the end to understand. Looking carefully at the chart, it is not difficult to notice that this boxy area, which we have marked prominently, is an extremely critical technical level. This area has been tested many times in past price action, and each time the price has reached it, it has been met with sharp reactions and pullbacks to the downside. This shows us that this box is not just a visually drawn area, it is also a strong resistance zone where the balance of supply and demand in the market materializes, where buyers and sellers collide most intensely. And this area is a strong barrier that can also be described as a supply block in technical analysis. So why is such a level so important that it cannot be broken? Because in technical analysis, the importance of a resistance or support area increases when it is tested more than once, not just once. The area inside this box has been an invisible wall against the price many times in the past, preventing the upward momentum from continuing. So every contact is an indication that there are a lot of sell orders here and that the market is struggling to break through this level. But everything has a saturation point. When the price repeatedly reaches this level, it also shows that the sellers there are starting to run out of steam. So no matter how strong resistance this area may seem, it may be slowly losing its strength due to the constant testing. This begs the question, what if this time the test is different, more voluminous, more decisive, and with a stronger bullish momentum? Then an upside breakout of this box would not just be an ordinary breakout, it would also herald the transition to a new market phase. A break above this box would act as a beacon for traders, creating a great deal of confidence in the market, because when a level that has not been breached for a long time is finally crossed, it creates the perception among traders who follow technical analysis that the direction of the trend has changed. This strengthens the hand of the buy side, prompts new buy orders, and accelerates the upward price movement like a chain reaction. In addition, after a breakout at such critical levels, the price often returns to this area and performs a retest. This is a very healthy behavior in technical analysis, because the retest after the breakout confirms that this old resistance has now become new support. This tells us that the breakout wasn't fake, and that the market has actually accepted this level. In other words, the price has gone through some kind of confirmation mechanism. However, there is also an important psychological dimension to be considered here. A price movement that cannot persist above this level and dips back into the box may create a fakey perception of a fake breakout in traders. This may cause panic and lead to increased selling pressure. Therefore, not only the breakout, but also factors such as persistence and retest should be taken into consideration. At this point, trading volume is also of great importance, because volume is one of the most important factors that measure the sincerity of breakouts. If the price closes with a bullish candle above this box, it would be technically logical to assume that this move could continue much stronger. On the contrary, a breakout that comes on low volume often ends up as a trap and can leave traders in a tailspin. Therefore, when analyzing the breakout to this level, it should always be supported by volume indicators. In addition, if the price manages to break this zone, there is a technically empty space above. This is because there is an area above this box where not much price action has occurred before. In technical analysis, such areas are called inefficient. The price usually crosses such zones very quickly. This reminds us of the possibility of a sudden and sharp rise after the breakout. So, a breakout of this box can open the door not only to new highs, but also to big moves in a very short time. As a result, the importance of this box pattern on the chart cannot be overstated. This area is a technical turning point. The fact that it has been tested many times in the past has shown the strength of the players in this area. But now, every new approach to this level signals that this barrier is getting weaker and closer to breaking. If the price manages to break through this level, it could initiate a much broader bullish move in the market with a succession of positive reactions. So let's look at other metrics so that the analysis is clear. Stay tuned. When we examine the chart in depth, we can easily say that we are facing a price behavior that progresses in accordance with the basic building blocks of the Elliott wave theory in the medium-term time frame. As of the current position, it is clear that the price action is about to complete the second wave of the classic five-wave bullish structure, or is undergoing a horizontal consolidation process within this wave. This is a critical juncture for investors, as many non-technical analysts may interpret this stagnation as uncertainty or weakness. However, the activity here is actually a harbinger of a much bigger wave. Second waves are often periods of correction and digestion in the Elliott theory. These waves represent the period after the first bullish wave, when the market rests and searches for new equilibrium levels. They are usually horizontal or slightly falling. The price does not set a clear direction during this period, but instead gathers strength before accelerating upwards. This means that traders may choose to take positions impatiently or exit in a hurry. For experienced analysts, however, this is a short breather in the middle of the uptrend. This calm in the market is like the calm before the storm and is often a precursor to a big breakout, such as a third wave. Looking at the current price behavior, we see that the price is fluctuating at levels that correspond to this kind of correction. This is perfectly in line with the characteristics of the second wave. Factors such as stagnation, sideways indecision, may be confusing for investors, but this is precisely the basic structural characteristic of this wave, digesting the previous rise while laying the groundwork for a new one. And here's the exciting part. Elliott's most aggressive and profitable wave, the third wave, comes on the heels of this recession. This is the phase when most traders return to the market, FOMO psychology kicks in, and technical indicators start to give largely positive signals. The third wave is so strong that it is often at least 1/618 times the size of the first wave. This measurement is usually based on Fibonacci extension levels. So when the second wave ends and the third wave begins, it is natural for the price to move up very quickly and strongly. In Elliott theory, the third wave is the strongest not only in terms of price but also in terms of volume and momentum, because at this point, the majority of market participants accept that the trend is now clear. Traders and investors who saw the first wave but hesitated in the second wave line up to take positions in the third wave. This leads to an explosion of buy orders and a rapid rise in the price. Moreover, this rise is often supported by a development in fundamental analysis. News, a deal, an announcement. Whatever happens, the price is now technically flying. But it is also important to remember this. Even after the third wave has started, many people are still hesitant. That's because the stagnation of the second wave has knocked the confidence of many investors. By the time the price starts to rise, it's usually too late. This further accelerates the third wave, as late entrants start buying at higher prices. Technically, this can be called momentum feeding. So the third wave is not only a technical extension, but also a psychological breakout moment. This is the point when everyone starts to accept the trend, big funds get into the game, and technical signals turn green in the clearest way. When we refer to Fibonacci extension levels to identify the targets of this possible third wave on the chart, the 1/618 level is usually considered as the first target. However, if market conditions are favorable and global developments or sectoral news support this momentum, the third wave may even extend to the 2,272 level. Such extended third waves are seen as golden opportunities for market participants, because the rise is not only fast, but also sustainable. In other words, it's not the price that shoots up on a single candle, but a trend that climbs up on consecutive and strong candles. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.